You're watching your money drop 20%. Your fingers hover over the sell button. Should you sell? Most investors panic and sell at the worst time. Or worse, they freeze, trying to get back to even while their money bleeds out. But here's what Warren Buffett and other legendary investors know. Selling is a choice, not panic. I'm Jack, and over the last 7 years, I've researched how Warren Buffett, Seth Klarman, and Howard Marks, other legendary investors, find the best time to sell. Today, I'm giving you their exact framework, a selling guide that removes emotion from choice. By the end of this video, you'll know the 6 scenarios that trigger a sell decision, how to avoid the break-even trap that destroys wealth, and why buying stocks without a plan is like a ship without an anchor. The moment rough seas hit, you'll drift away. No more guessing, no more regret. Let's dive in. Let's start with the most important rule in selling. Never sell a business just because the price went up. Warren Buffett says his favorite holding period is forever, and there's a good reason for that. Every time you sell a stock, you lose money in 3 ways. First, you pay broker fees. Second, you pay taxes on your profit. Third, you lose the growth that a great business would have kept giving you. Let me show you what I mean by using a real example. Apple stock. Since 2015, Apple's share price has dropped more than 30% 4 times. 4 times. And every single time, if you'd held through that drop, the following year it returned 80%. But here's what most investors did. They panicked and they sold. They wanted to protect their gains or get out before it got worse. And every single time, they missed out on massive returns. Or look at hedge fund investor Allan Mecham's journey with Monster Energy. Over 11.5 years, where the S&P 500 turned $10,000 into $11,000, so made $1,000 over that time, his fund turned $10,000 into $60,000. That was because he'd held on to great businesses. In those great businesses, that included Monster Energy. And he held through the ups and the downs, even when everyone else in the market was panicking and selling. His return from Monster alone turned $10,000 into $580,000. And here's the lesson here. A high price on a great business is not a reason to sell. If the business is still strong, it has a good competitive advantage above its competitors, management are still A players in their game, and the future still looks bright, then hold. Don't sell. Let your winners grow. Most investors make the opposite mistake. They want to sell early because you can't lose making a profit. And they hold losers too long because they want to get back to even. And that break-even mentality, that's the biggest wealth destroyer in investing. Here's why. Here's the trap that destroys more wealth than anything else. You buy a stock, it drops 30%. You think, I'll just hold until I get my money back. So you're down 30% and you're gonna wait for it to get back to zero before you sell. That makes sense, right? Wrong. This is called the sunk cost trap, and it's killing your returns. Here's why this trap is so dangerous and why it hurts so much. First, the stock doesn't care what you paid for it. The market cares about the future, not your past. Second, while you're waiting for your money to grow back, it's sitting there. It could be better spent elsewhere and growing, making you money somewhere else. Third, you're making emotional choices, not smart ones. You're looking backwards, not forwards. Howard Marks, legendary investor, says it this way. Why sell a low-priced asset just because you think it's going to fall for a while? The stock market doesn't care about your past. It cares about the future. Let me give you a question that changes everything. If you didn't already own this stock, would you buy it today? If the answer is no, then you're most likely holding it out of emotion. You're holding because you don't want to be wrong. You're holding because you want to get back to even. But here's the truth, and I know this stings. Your money is already gone. The question isn't how do I get back to even? The question is this still the best place for my money right now? That's the question that actually matters. If you had a written plan from the start, if you had your anchor, you'd know the answer to that immediately. Buying stocks without a written plan is like a ship without an anchor. The moment rough seas hit, it drifts away. And you have nothing to hold you steady when those rough seas hit. But here's the good news. I've created a when to sell framework and guide that summarizes the rest of this video. It's in the link in the description, and it walks you through the entire process. Something challenges your decision, grab it out, read through it, answer the questions, and you'll know exactly what to do. You can grab it in the link in the description. It's free. Print it out, put it next to your desk, and it's there ready for you when you need it most. Because the investors who win aren't the ones who guess. They're the ones that have a system. But having a system means nothing if you don't know how to use it. So let me walk you through the exact process right now. Here's the framework. This is your selling guide. something happens that makes you question your original decision. So the stock price drops 30%, it's just your annual review. Maybe it's just bad news that breaks, but you've got it there ready. When that happens, don't panic, don't react. Walk through this process. Step 1, look at your original buy decision. Pull out your written plan. Why did you buy this stock originally? What was good about it? Or what was bad? What were the things that you wanted to look at and check? What is your original reason? And here's where most investors hit a wall. They don't have a written plan. Think about it. If you can't remember why you bought a stock in the first place, how do you know when to actually sell it and for why? So if you don't have this yet, pause the video right now. I'm serious. Take the time, write down a reason for why you own each one of your stocks. It'll save you so much money and so much time and headache later. Step 2, run through the 5 M's. Once you have that original plan, you want to make sure if they're still valid right now. I use the 5 M's framework. 1, mastery. So is the business, is it still mastering its customer? Has it been consistent? Is it continuing relatively unchanged? Moat. Is the business's competitive advantage still strong, and is it still beating its competitors? Management. Can I still trust the management team? Are they still being candid, telling the truth? Are they still aligned with shareholders? And are they still allocating money rationally? Margin. Is how overvalued or undervalued is the business or the stock price at this moment? Maintain. Is this still the investment where I'm going to get the best return for my money? Or has it dropped from where it should be? We usually do this by reading through the annual report and conducting that, well, annually. Usually doing that tells you everything that you need to know. Because here's the truth. If the reasons for buying originally are still true now, you hold. Even if everyone's panicking and selling, or the stock price goes down 30%, you should hold. But if your reasons have changed, that's when we sell. Okay, but your reasons changed is pretty vague. What does that actually mean in practice? Well, let me break down the exact scenarios now. After you've revisited your buy decision and checked the 5 M's, you're going to land in one of 6 scenarios. Let me walk you through each one. Scenario A, the fundamentals are still strong. The business quality is unchanged. The moat's intact, future prospects still look good, and the management team are doing pretty well. Your action, hold. Even if the price is high, hold on to your winners and let them compound. This is where most investors mess up. They sell them because the price went up. Don't do that. As Guy Spears says, I should be reluctant to sell a great business at any price. The trouble is, it's difficult to buy a great business once, let alone twice. Or Charlie Munger put it a bit more concisely. Find a few great companies and just sit on your ass. Scenario B, you made a mistake at purchase. You missed something that may or may not have been on your checklist and you didn't catch it at the time. So your action should be to sell immediately. Then update your checklist and think through how can you improve it and make sure you don't make the same mistake again. Document the lesson. So every mistake is a chance to improve your process. Scenario C, business fundamentals have changed. So the company has deteriorated over the time that you've owned it. So the future prospects might be worse, the moat and competitive landscape might be getting more challenging, or the management team are starting to make irrational decisions or just being plain not truthful. Your action should sell. Don't wait for it to get worse. Scenario D, future fundamentals are slowing. The business is entering its decline phase, so the industry headwinds might be increasing, competitive threats are increasing, and the growth runway is shortening. Your action should be to sell before other people realize it too. Scenario E, portfolio correlations changed. So you thought these stocks might have been different, but they actually move together. They have common threads that make them move together in the stock market. And you might have made that mistake at the purchase or over time as the amount in your portfolio has changed. Maybe some positions have grown, taking up much more of the original portfolio than were first put in. Now, Howard Marks says, investors often fail to appreciate the common threads that run through portfolios. Your action, keep the strongest one and trim or cut the weakest one. This reduces your risk of them all falling at once or becoming obsolete at the same time. Scenario F, a better opportunity becomes available. So you might have found an idea that's significantly better, and the stock that we're looking at ranks the lowest prospects for the future. Now, your action would be to sell and reallocate that money to that better opportunity. And that needs to be a much higher conviction. Now, the key word here is significantly better. It can't be marginally better, it needs to be significantly better. These 6 scenarios cover 90% of selling decisions. And notice what's not on the list. The stock price went up. That's not a scenario. I want to get back to even. That's not a scenario. Now, knowing these scenarios is one thing, but actually being able to act on them when emotions are high, now that takes discipline. And that's what we're going to cover now. Let me wrap this up with 6 principles, and these are non-negotiables. Principle 1, always start with your written buy decision. If you don't have one, you're already drifting. You're a ship without an anchor. Stop now, write them down. You need pen and paper. There's no excuses. Principle 2, conduct reviews annually with the 5Ms. So quarterly, if something triggers it, read those annual reports, check if the reasons that you owned it for have changed or if they're still valid. If you don't know how to read an annual report, what to look for, or a framework for assessing it, it's free download in the resources below. The link's in the description. It's all there. There's no excuses. Principle 3, never sell a business just because the price went up. Now let your winners compound. This is where wealth is built. Warren Buffett says, diversification is a protection against ignorance. That's a perfectly sound approach for somebody who does not feel they know how to analyze businesses. And when discussing diversification in 2008, he said that's crazy for somebody that really knows what they're doing. The typical Wall Street advice is buy everything, hold everything, never beat the market. That's modern portfolio theory. That's for people who don't want to think. Seth Klarman said, diversification for its own sake is not sensible. This is the index fund mentality. If you can't beat the market, be the market. But if you're willing to study businesses and think for yourself, you can do better. Peter Lynch proved it. All you need for a lifetime of successful investing is a few big winners. If you don't know how to pick winners, wait till the end. I got something for you. Principle 4, every sell decision is a learning opportunity. Update your checklist, get better. You either win or you learn. Don't get bitter, get better. The best investors always hone their skills. Principle 5, think forward, not backward. Focus on the future prospects. Like I said, not the purchase price. The stock market doesn't care what you paid for it. It only cares about the future. Principle 6, be ready to sell when you want to, not when you have to. Position yourself well. Have cash that you need for opportunities. Don't get forced into selling your best holdings because you need the money. Being a forced seller is the worst position to be put in as an investor. Always be prepared. So here's the truth that we started with. The moment that you buy a stock without a written plan, you're already lost. You're a ship sailing without an anchor, drifting wherever the market pushes you. But now you have a framework, the same framework that the greatest investors use. Your homework, go and write down all the reasons why you own what you currently own in stocks. Then write down your buy decision using the 5Ms framework. That's your anchor. Next time you're not sure what to do, and that day will come, you'll know exactly what to do. Grab the when to sell framework and the other free resources, the link's in the description. They're going to save you from making emotional decisions that'll be costly mistakes. Hey, and let me know if you like this by hitting the like button and subscribing if you want to learn more about these great lessons from investors. And drop a comment and tell me what's the biggest selling mistake that you've made. Or has it been in holding it? Let me know. I read every comment. And if you want to go deeper and build on your own investing strategy and how to pick stocks, you need to check out this next video that I've made up for the stock hunters. It breaks down the 5-step framework that legendary investors use to find stocks before Wall Street even notices them. That's your next step. It's on screen now, so you can click it. Thanks for watching. Get after it, boys.